Every day I get calls, texts, emails from people saying they want to use their rental income to qualify. You actually can. The problem is that what people think they can use and what they can actually use are different. And that becomes problematic because if you are incorrect in the rental calculations that you use, of course, that is going to cost you in your buying power. Well, today I'm going to share with you the actual way that lenders calculate rental income used to qualify, not only if you already own rental property, but if you're looking to purchase future rental properties. And then if you stick around, I'm going to show you about 65% of the way into the video, I'm going to show you a way that you can use rental income to qualify and not have to provide any kind of income or employment related documentation. That's right, a loan that exists solely based on what the property can rent for. My name's Aaron Benton. I'm a local mortgage lender here in Hilton Head, South Carolina. I get texts, emails, calls every day from people just like you looking for home financing advice. So today's question is, can I use rental income to qualify? And the answer is yes, but stick around because I'm going to show you exactly how that rental income is calculated right now. So let's play the first example out. You are looking to purchase a rental property and you are looking to use future rental projections. Well, the mortgage banking industry utilizes the appraiser to be able to provide what those future rents would look like. They most likely are going to get rental projections from the management companies, because you can imagine in Hilton Head and Bluffton there are short-term and long-term rental management companies that are well versed in these numbers. So the appraiser goes, and part of the appraisal, not only is the appraiser assessing the value of the home, they're also assessing how much this property can rent for. And we as the lender will order what's called a rent schedule. So now let's play it out. Let's say that the rent schedule comes back and it says the property can rent out for $2,000 a month. We then will take that rent projection from the appraiser. We will multiply it by 0.75. There is a 25% discount for what's called vacancy factor. That's right. Many times, now that doesn't mean that when this is all said and done, you'll still make your $2,000, but we as the bank have to take into consideration a 25% vacancy factor when utilizing conventional loan, a mainstream loan, Fannie Mae or Freddie Mac backed loan. So let's say you rent it out it's projected out for $2,000. I have to take a 25% haircut, that's $1,500. I then have to subtract away the principal, the interest, the taxes, the insurance, potentially an HOA, and potentially a condo fee. So you can imagine, even though you think you're going to be making money on the property, the bank might just say, hey, these offset each other, which is a good thing, because that means if you came in and you had your certain debt to income ratio already projected out, and now you're buying this property and all the numbers work together, you no longer, well, you can buy the property and your debt to income doesn't change. It shows that the property is going to at least carry itself. That's a win for you. You still qualify for that mortgage. And remember, at the end of the day, you are going to make whatever you're going to make on the property, and there is no 25% deduction from your income on that piece. So the bank will utilize a rent schedule to kind of be conservative. Where does that matter? Well, a lot of people will ask me, what is the maximum investment property that I can buy? That is a very hard question to answer. Because what I said to you just a moment ago was that the rental projections can many times offset the entire expense or the cost of the property. Therefore, what really can hinder people is the down payment. So the minimum down payment on a investment property is 15%. Many people would like to put down 20 because that gets them out of what's called mortgage insurance. And if they put down 25%, that will see better terms. You can think of interest rate as a product of risk. The more you put down, the safer you are, the lower the interest rate. So the interest rate at 25% will be better than 20, just like 20% down is going to have a better interest rate than 15%. Nevertheless, the key here for you to understand is that it's hard for me as the lender to give you the maximum investment property purchase price, because if you had, let's just play out, you had an endless amount of down payment that you could come up with, well, you can imagine as you increase the value of the property, most likely your rental projections are going to increase as well. So that's something that you want to get in touch with your real estate agent, because you're picking the perfect property, which property is going to show you the best return. And yes, maybe you are buying a more expensive property than you thought or that you initially planned on, but in turn, you're getting greater rentals from that. Therefore, everything kind of ends up as a wash, and you get the better property or the nicer property than you originally thought. So a win-win there, but just recognize that yes, maybe you could think you're gonna make $2,500 a month in rental income, but you might not make all of that, because there's gonna be a little bit of a deduction based on what the lender is gonna calculate. Now, next example, let's say that you already own real estate and it's embedded inside of your tax return. Many times you'll see this on what's called a Schedule E of your personal return. Some people will have S corporations or partnerships, but let's just say that you have the Schedule E, which is just a schedule on your tax return that holds the rental property. And what you get to deduct is the interest, the taxes, the insurance, the HOA or the condo fee, you get depreciation. But recognize that when I am going through and seeing how that property carries itself, many people will tell me, hey, I make a lot of money on this property. And then I get the tax return. And the tax return shows that they have a ton of expenses. They have repairs, there's travel, there's a whole bunch of advertising, there's a whole bunch of different expenses that I cannot necessarily add back. Therefore, the property, per mortgage guidelines, isn't as lucrative as you may have thought. So it is one of those situations where when your lender is allowed to see your tax returns up front and early, we can quickly make that calculation. Again, this is based on a property when you've already owned it, and I'm just simply looking at the tax returns. All right, the moment you've all been waiting for. How do I buy an investment property and not have to use my income or my pay stubs to qualify? How can I get a loan and I just solely look at the rental projections of the property and say, hey, this is going to carry itself. This is a good investment. It's called a DSCR loan, debt service coverage ratio loan. And what that looks at is how much the property can rent for. It could be on a long-term basis, and it could be on a short-term basis, depending on the market that you're in. You get to decide, your lender gets to decide what numbers are going to best strategize for you. So me, living in Hilton Head, South Carolina, you can imagine when utilizing a DSCR loan, we are going to use short-term rental projections over the long-term rental projections, because the short-term certainly outpace. I'll give you a great example of this. I was actually doing a deal right across the bridge in Bluffton, South Carolina. And the property had an ADU, which is called an accessory dwelling unit, and then the main property was a duplex. So technically 3 rental properties all on one parcel. I was looking at the short-term rental, the DSCR. This property was going to be up 150% more than his payment. The borrower was going to put down 20%. He was going to have a payment of about $5,000 a month, and he was going to be making $7,500 a month. Where did I get that number from? Well, you get a choice. The appraiser can provide the rental projections, just like we talked about before. We could have them go out, do long-term or short-term, or there is a website called AirDNA. That's right, AirDNA. And it is linked to Airbnb, and what it looks at is it looks at the surrounding area to see how other properties are renting out to provide projections. So in this case, I was able to use the AirDNA of $7,500 a month to qualify this gentleman on a DSCR loan. He did not need to provide income documents. All he had to do was cover his 20% down. He had to cover a couple months of reserves, little rainy day fund, and of course his closing costs, which by the way, you could ask the seller to pay a portion of your closing costs. Very real life scenario there. What you want to understand from this whole video is that yes, you can use rental income to qualify. It might not be the exact number, but remember back to what I said in the beginning, it's hard for me to give you the max qualifying number should you have an endless amount of down payment. Many times the down payment amount is what is going to hold us to a certain purchase price. But understand, as you go up in value, many times the rental projections will increase accordingly with the actual payment, your monthly responsibility going up as well. So those will kind of go up linear together and coincide. So my name is Aaron Benton. I'm a local mortgage lender here in the Bluffton Hilton Head area. All the things I've talked to you about today, not only would they apply here in the Lowcountry, but they would apply nationally. So whether it's here or other states that you're looking to purchase in, what I just shared with you of how rental income is calculated, the use of AirDNA. Again, some markets are going to have short-term rentals will probably outpace long-term or vice versa depending on where you are. But nevertheless, you can use rental income to qualify. My name's Aaron Benton, local mortgage lender here in Bluffton, South Carolina. If you want to understand your actual numbers, I encourage you to reach out. My information is listed below. Tap the bell for notifications so you'll be the first to know when I release any new videos. I hope to one day get to meet you, but if not, I hope to at least see you on the next video.